All right, y'all, we live. So the Fed meeting is happening. Okay, we're gonna see like what is he gonna do? Okay, we seeing the crypto market and the stock market looking a little stable today. Um, let's go into actually what Jerome Powell gonna say and what he got going on.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor...
Y'all see the paper shaking at the bottom? Check it out. Seems like he a little nervous talking today. Is it me? Or is it, on my reach? Check it
market
out.
continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path.
It's like him and Biden is not even on the same page because the numbers he's screaming and then the numbers Biden screaming. It's like two total different numbers, man. Is Biden lying or what, man? What's going on?
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power,
from paper,
especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points,
Nervous.
bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Really looks like y'all pushing
Reducing
inflation.
inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Really?
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris,
See 10 people. I got one.
Chris Rugaber, the Associated Press. Thank you for doing
What
this.
you got, dude?
As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the
They being so
disinflation that
nice
we
with the question
have
from
seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the In the housing services sector, we expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
All right, y'all. So they being real easy with them with the questions. I would have asked them something, you know, a lot more like, why is it the numbers that you're saying and the numbers that Biden's saying don't correlate? What's really going on? Okay. You don't want nobody like me up there talking, because I'm going to be asking some questions where I want to get some answers. You can't just read off a piece of paper for me. Not saying he probably just doing his job, but I'm going to be questioning some real important questions. And it seems like, you know, they're being soft and, you know, he up there shaking with the paper. Let me know what y'all think in the comment section, man. You know, is inflation coming down? Seems like we're going to have a bear month in February in the crypto and stocks, because we had a great month last month. So probably gonna be a great month to be buying in. So let me know what y'all think. I'll catch y'all in the next video. Peace.